right, ladies and gents, let's let everyone drift into this webinar. We'll get started in a moment or two. Just watching the Dow make a little bit of move to the downside at the moment. As I am speaking, not quite out of the year's risk range yet. Still sitting in that multi-day range. A bit of a funny start to the year, really. But a red across the board. Nasdaq down, Dow down, DAX down. The Dow's the one's getting hammered, isn't it? All the constituents of that. FTSE not doing too well either. Russell looks worse, actually, down 1%. What else have we got? Yen spiking. Yeah, so gold. Yeah, mixed bag, real mixed bag. Things need to, from an index perspective, I think we need to resolve one way or the other. Tomorrow will be telling, the close will be telling today, from looking at the Dow perspective, Dow point of view. What is it close today? Does it recover? What happens tomorrow? Do you get follow through? Do you get a kind of futures drift overnight? Then it gaps up. Also, it gaps lower, then fills the gap. You know, there's things to kind of look at and adjust and calibrate to, I think, before, you can really take a view on a kind of 2 or 3 day play. So definitely be keeping my eye on that. All right, so everyone's drifting in. Good to see you. Good to see you. We're on Zoom rather than the GoToWebinar. So let's see how we get on with this. You should all be able to hear me clearly. Everything's good. We're recording. We'll start in about 20 seconds or so. We want to start 6 o'clock on dot. Got a lot of stuff to cover. It's going to be a good one. First webinar of the year. Let's make it a nice, good one with a lot of actionable, valuable content. Okay, so, all right, usual thing, guys. Please understand the risks involved in trading. High risk, the score, spread bets, CFDs, they're leveraged instruments, right? You can lose money quickly. You can make money quickly, but you can also lose money quickly. Understand the product, understand what you trade in, and as always, guys, I'm just here to share some experience, share some insights, share some knowledge. And my hope, as always with these, is that you have, a couple of things to take away. That's all. I don't tend to have all the answers, absolutely not. But I really try and put these together and think, okay, what can I include that's going to be valuable to you as a trader in your trading that you can use? So that's my kind of objective for today. So how this will work is we've got a Q&A. I'll talk for about 45 minutes or so, and then somewhere you can ask a question in the Q&A. I'm not going to look at those until the end of the webinar. So if I don't get to it immediately, fine, I will get to it at the end. I'll try and get through as many as possible. Great quote here from Richard Branson. Do not be embarrassed by your failures. Learn from them and start again. Very, very apt in trading. Okay, so we're going to talk about the ATR indicator. I think it's one of my my second favorite indicator. I'll gotta be honest. I think VWAP's my first, but you can't really. Can you call these indicators? Yes, technically they are. Of course they are. But sometimes I feel, I maybe I give it more credit than be calling it an indicator, because I always feel that, hey, people are using indicators to, you've got this signal, that signal, the other signal, without actually understanding what the indicator is going to telling you. But today we're going to really dig into some decent stuff with the ATR, because I like it because it really gives you a good insight into the characteristics of the market, right? And I don't want to kind of jump ahead of myself here, but that's why I like the ATR. So let's go. Let's get rolling. Okay. Just a quick reminder, as I said before, I don't have all the answers, guys. I'll share with you my ideas and thoughts. Do your own research. As always, that's how you get to move forward in your trading, your own research, your own homework. Hopefully, I guess the webinars are the idea of this, guys. And by the way, first one of the year, welcome back. Happy New Year to you. Got a few lined up for the rest of the few months ahead, or for a few months ahead. So really looking forward to sharing some insights and information with you to help your trading. But I think what I really try to do is I know you're not going to take everything and go, yeah, it's really, really great. I want all of that stuff. But if it just ignites a spark in your brain of, that's interesting. Let me explore that further. That's what I want to do to you. I want to get that spark going. You go, do you know what? I'll explore that. And maybe you explore it and go, you know what? Maybe not now. Or maybe you explore it and go, that's exactly what I need to help me with this issue, whether it's a strategy, whether it's, placing a stop, whatever it may be. So that's kind of the objective, is to, I know not every single slide is going to resonate, but I just want to get that spark in your brain that goes, I've not thought of it from that perspective. And if you do that, then go and do your own research, analysis, homework, etc. Then you'll pick it out yourself and go, great, I can use that, I can implement that. Things take time, implement a change, stick to it. Don't get this shiny object syndrome that you'll often get when we're traders. Observe the results and make course corrections. And what I mean by this, and why I include this slide very often, is we have to stick to something for a period of time and then review the performance of it. If it is a different stop, if it is a different strategy, if it is something slightly different, we're all guilty of this at some point or other, taking or making a change. One day doesn't work. Oh, it doesn't work. I'm going to do something else. Just stick to it for a while, then observe, and then make little adjustments and course corrections. And don't give up on the iterative process. You can't fail to get where you want to be if you decide not to give up. I think it's something to consider. Okay, topics for today: introduction to ATR. I'm going to do a couple of the slides, and there's a reason for the slides. I'm going to tell you a little bit about the ATR, how it's constructed, and I know I never normally do this type of stuff because it's a yawn fest. Oh, no one cares how it's calculated, but it's important because it kind of makes you think about the usage of it. So we'll spend a moment on that, then we'll go into some ATR-based strategies, risk management techniques, and some practical applications of ATR. And as always, it's information. This is for information purposes only. Don't copy what I say, and do your own research, of course. Q&A at the end. Let's go. ATR is average true range, of course. It's an indicator. It measures the market volatility. It measures your range. And Wells Wilder was the first guy who kind of developed this. He's done other stuff like parabolic SAR, RSI, all this type of stuff. And what we're trying to do with ATR here is it helps us adjust the strategies, helps us deploy strategies, helps us manage risk, because it gives us almost like a rev counter to the volatility. It's not the VIX, but I'll show you in a moment how it is kind of generally correlated to the VIX. But it helps us really, understand the market we're trading and calibrate to conditions. And I've always talked about this. I'm a big fan of that. If you've listened to any of my webinars and stuff, you know that calibrate context, I guess, is the official terminology for it. But calibrating to conditions is such a key part of being a good trader. If you're trying to trade in conditions that are way too volatile, a strategy is it's not suitable at all for the volatility, you're just going to get smashed. You're going to get your face ripped off, for want of a better term. The short ripping face sentence everyone talks about, and trying to think there. Well, the other one, another allergy is traders have some pretty grim stuff. Dead cat bounce, face ripping, but you've just got to make sure that you're aligned with the current conditions, right? And ATRs are very good at doing that. So, an example, you probably all put it on your chart. It's here anyway. ATR on TradingView on the bottom, it looks like that. Standard little chart. It goes up and down, depending on the range, how the range is adjusted. We'll talk about a little bit how it's calculated and the settings that I prefer, and then we'll get into some strategies. So, I'm not going to spend long on this. I promise you, I'm not a maths nerd. I'm not really interested generally, but it helps to think about how it's calculated so that you can come up with own ideas and ways to use it. Because very often, beginning traders, I've done this myself, fall into the trap of, I like that indicator. Let me put it up there and see what it does and try and find a strategy around that. That doesn't work. It just doesn't work. In fact, I remember many years ago, I want to say 2004, something like that, maybe even 3, maybe even 2. I went to London to a trading seminar to learn how to trade. Not much stuff on the internet back then. The internet wasn't obviously as mature as it is now. And I remember sitting in this seminar and a guy talking about stochastics, right? I remember it distinctly, stochastics. So that sounds pretty good. I don't know, stochastics. Oh, yeah, all right. So I'm writing little notes down and stuff, and I go home and put my stochastics, and he's telling me, when it's oversold, you buy. When it's overbought, you sell, you go short, and this is kind of how you structure it. And I thought, brilliant. I'm going home and loading up this, old-fashioned charting platform, trying to get stochastics on it. Finally got it working, thinking this is it now. Stochastic sounds great, sounds clever. I just buy when it's oversold. I just sell when it's overbought. Man, I am gonna be so rich. I can't wait. And I was putting the stochastic on. I'm trying it on in 1 minute. I'm trying it this 5 minute. I'm trying it, and honestly, obviously, it's completely the wrong approach. Trying to find a strategy based on an indicator is foolish, I believe. You want to be able to understand the concept of price action, then use an indicator to help you, guide you into as a filter, as a trigger, as a reason to get in the trade, as a reason to stay out of the trade, to identify, fruitful market environments. That's where indicators have a value. And they have to be that second step rather than going, I'll put the indicator on and I'll look for, some kind of signal that's going to work, because you'll never trust it anyway. So ATR is averaging the true range over a specific period. So, interestingly here, the true range is not necessarily the high minus low, which is the range. It's actually the current high minus current low, the absolute value of the current high minus the previous close, and the absolute value of the current low minus the previous close. So it takes into account the close, which is why when you are using ATR, you've got to be mindful of gaps. Now, if you're trading Forex, obviously there's very few gaps. At weekend, you might get a little bit of gap. If you're trading, on the index products on Pepperstone, like the Dow, like the Nasdaq, etc., or their equivalent, they're not going to have gaps, so it's not going to affect you. But if you're trading something that does have a closing time and opening time, then the ATR is going to adjust for that. So you've got to be a little bit careful as a day trader. You're not getting influenced by those gaps. It's something to mention. I wanted to mention, but just understanding the maths behind it and how it's calculated. We don't need to know all the intricacies, but it's important to know that it's part of it, especially when using an indicator from TradingView and all the other chart platforms use MT4, etc. They do have a traditional ATR calculation which takes into account the close. So just something to bear in mind. It's not that important, but I would be foolish not to mention it. And then basically it takes an average of those ranges, and then you go, okay, let me go back. You go, right, we need to identify the true range for each period. We take the largest, and then you go, right, what's the average of the largest of those? And the default setting is 14. So if you've got 14 period ATR and a daily chart, it goes back for 14 days. And there's the equation for what it's worth. But that's the beauty of charting platforms, boys and girls. It does it for you. We don't need to know this. But what I think is important is understanding the roots of it. So 14 day or 14 day from a daily chart. I put period there. Period, if you're on a 5-minute chart, it'd be 14 5-minute candles. You get the idea. I think you get this. I quite like a 10. And I'm going to talk about why I like a 10 in a moment. For some reason, 14's default. Whatever. Does it make much difference? Yeah, it does a little bit. It does a little bit for sure. But just know what you're doing. Obviously, the same with the moving average, right? The further you go out, the more smooth it's going to be and the more sort of data you're taking. And the shorter it's going to be, the more noisier it's going to be, the noisier it's going to be, and the less data you're taking. As a day trader, short-term trader, you want to go, in my opinion, you want to go a little bit narrow, because you're starting to take stuff that happened 14 days ago. I kind of don't care. I really am interested in this week, the last 5 trading days, last 10 trading days. When I start getting out further, it's probably not the same conditions, because conditions change and adjust. We have these little spikes in volatility, the backfills, the trending break, so personal preference, and nothing wrong with using 14 period, but I want to share that with you. Okay. So, let's just understand the volatility concept. So volatility is a measure of price fluctuations, right? I think most people get the idea of volatility. Higher volatility is more opportunity. And that, again, that's a bit of an opinion for me. Some people like to trade. I don't know why you like to trade low volatile environments, if I'm honest, because the spread becomes more impactful. You don't get the follow through. But hey, like I say, I don't think there's a right or wrong way to trade. Well, I do think there's a right or wrong way to trade, but I've seen other people doing different things. So I generally think the high volatility is better opportunity. Now, sometimes it can get very high. It's too high. Fine. During news or something stupid like that, I get it. But generally speaking, I want a nice rhythm, a nice structure, a nice kind of wave that I can get my teeth into. And so if we measure volatility, it helps us go, right, what are the likely price movements? I'm going to talk about that in a moment, because I think that's one of the biggest advantages of using ATR. Managing risk, you may have heard that before, but stop losses we can use on ATR, and making better informed trading decisions. And I'll share with you something I use to kind of as a filter to keep me out of stuff that I just don't want to be involved in. I don't want to be involved in chop. Chop is my nemesis as a trader. When the market is just chopping around, just flaking up to highs, flaking down to lows with no follow through, I hate it. I don't like it. I'm not very good in it, and I hold my hands up to it. So easiest solution to that is let me avoid it. And maybe you're the same. Maybe you do some great trades, then you get caught trading chop. You're like, why am I trading that damn chop? I'm getting caught in something I shouldn't even be trading. So a great way of kind of using the ATR as a filter to avoid that, just like a binary. Hey, green light can trade, red light can't trade. Not talking Squid Games here, we're talking ATR. All right. So it will mean nothing to you if you haven't watched Squid Games, but if you have, it will mean something to you. Okay, market values and market insight. High ATR, obvious stuff. There's large price movements, more setups, I believe. Maybe controversial, but one of the okay, pause this for a moment. One of the advantages of trading in high volatility environments, I believe, is that you get the opportunity to have more trades. Now, you might be like, well, that's over trading, Mark. No, it gives you more opportunity. You have to take all of them. But if you've got a decent swing intraday, testing highs, testing lows, pulling back to VWAP, breaking out, doing this, has lots of different market structure and different kind of rhythms to it, then you get 4 or 5 good ideas to trade. And if you miss a couple, you've got some more coming down. If it's not very volatile and it's a low ATR, you might get one, like an opening range break or a pullback from the open or an open reverse drive or something, and then it just sits there and does nothing. And you can't take anything out of it. And then you end up, if you're not careful, over trading, frustration. So a high ATR generally, I believe, is just a better market environment. More setups gives you more choice. You can be more selective. And of course, we are imperfect. We don't trade perfectly. This is the real world, guys. We're on the front line here trading. We know we make mistakes. We get stopped out. We miss things. We get a bad fill. But more opportunity means you can recover from that. Hey, I missed that trade. Got stopped out that a little bit early. Took a stop. It's okay. The market is in a good rhythm. There's a high ATR. There's going to be 4 or 5 trades coming up, and I just need a couple of those, and it'll undo the losses from that and end me nicely in the green on the day. A low ATR just doesn't give you that. So it's important from not only a tactical perspective of how we pick trades, and we'll talk about some strategies in a moment, but also from that filter. Let me just stay out of stuff that's got a low ATR. I don't believe I've got edge, and you probably haven't got edge either. Let's not risk our capital in places where we don't have edge. Let other people do that. Like, you're probably in the webinar, you maybe got a bit of experience, and whatever experience level you've got, just avoid the stuff where you don't have edge. You don't want to be risking capital where you don't think you can profitably trade. We don't know it's going to be a profitable trade, but there's no point, right? That's how we do damage to our account. Okay, and actually, going off piece slightly, I think that one of the biggest things to traders is obviously over trading. But interestingly, in a high volatility environment, over trading, yes, you can get caught out, but it's kind of a bit forgiving in a way. What I mean by that is, if the market's swinging around, maybe you get stopped or whatever, because there's opportunity and it's moving, you almost can get away with it a bit. But the over trading and chop is what kills traders, because they're trying to predict the next candle. It's going nowhere. They perceive that there's actually, hey, I feel like I know where that's going to go. And really, it's just noise. The market is just operating in a noise environment. So, one of the big things that for traders is reducing those losers. And I bet that if you went back on your trades, you looked at the time you were involved, you're like, man, it's just rubbish trade. It's back and forth. I call it dirty candles. Nothing's going on. I just don't want to get involved in it. So very useful for that. All right, enough of that. Let's rising ATR, increasing volatility. I think this is obvious with larger price movements, falling ATR, decreasing volatility. When ATRs are kind of flatlining, obviously sustained high periods of low or of high or low volatility. And you got to drink every time I say volatility tonight. Or ATR, even better if you really want to get drunk. All right, look, example here. We've got a Dow daily chart. Bar chart, just so I can get all the stuff in. You can see how the ATR kind of starts to just sit there and do nothing as we're sitting in a range. And actually, generally in an uptrend, ATR declines because the volatility is not as high. But look how it spikes in a downtrend. We get these kind of move down. That's when it spikes. That's worth remembering. High ATR environment, often to the downside because there's fear driving the market. The chugging uptrend we had kind of towards the latter part of last year, we had little bursts, right? But it just chugged. It was just comfortably chugging. We had some of the lowest ATR readings we've had for many years. So something to be aware of. Okay, wrong way. And look, this is the correlation between VIX and ATR. Very, very similar. Very, very similar. which makes sense, right? Because the first chart we saw was ATR rising as market goes to the downside. What do people do when the broad market falls to the downside? They buy options to protect against their portfolios. When they're buying options, the premium goes up. The VIX is the premium. So we see this kind of spike in ATR as markets go lower, a spike in VIX. So when people say they use the VIX and stuff, fine. It's not identical, sure, but it's giving us a similar way of looking at things. And the beauty, of course, of ATR, we can use it on any market. We can use any market. I'm making generalizations a little bit here, and I appreciate that. Some of the more advanced traders are going, "Oh, I'm generalizing a bit." I get it, but I'm kind of saying, hey, it's a good approximation. It's good enough for most of what we want to do. If you've got a very specific, intimate strategy using the VIX, requiring the VIX, I get it. You might want to use the VIX, but this is a good sort of proxy, if you like. Okay, so volatility spikes, sudden, sound like Sean Connery, sudden, sharp increases in market volatility. Fine. Rapid movements in one direction, short period of time, big movement, short period of time, high ATR. Unexpected news or expected news, economic calendar, market sentiment shifts. Remember that for a moment. Example here to chart before we get to the strategies. This is a 5-minute chart of the DAX or Pepperstone's equivalent, German 40. You can see how the ATR picks up at the opening bell, which is 8 o'clock UK time, when the actual underlying stocks trade for the DAX, and then it kind of declines again after the closing bell. Obvious, but I think some visual representations are important. Okay, final thing on this before we look at some strategies and filters. And I'm hopefully, again, I'm laying the foundation here. Pros and cons of ATR. It's simple. It adapts to various conditions using all markets. Enhances other analysis, I believe. Good risk management tool. The downside is you can't use it standalone. I don't think you can use any indicator standalone. Maybe you could obviously have price as well. Maybe you could. I don't think you could. Okay. Lagging nature, of course, doesn't tell the whole story. There's other things to consider. And of course, you can misinterpret it if you're not careful. There's no silver bullet in this game, guys, but it's a useful tool. All right. Let's talk about ATR-based trading strategies. A useful filter is you will only trade when the ATR is greater than X. So when the price moves from, or the market environment, should I say, moves from one mode to another. That is one way of doing it. And we'll talk about that in a moment, give you a real example of how I set that up myself. A strategy that's important, ATR spike. Now, there's a trade at the moment that I've been really exploring in depth. It's been working exceptionally well latter part of last year. It's kind of got off the board a little bit the first couple of days of this year, but it's just a nice concept in general. The afternoon breakout as well has always been good. So before I kind of go into that in detail, the idea here is when the market goes from kind of low volatility phase to a higher volatility phase, the ATR is going to spike, just as we talked about in a few slides before, right? ATR will spike. So when price starts to, and I've kind of simplified this slightly, but if you have a price target, right? And there's two ways of looking at this. And examples I've got a 6 o'clock shock and afternoon breakout, which I'll explain those in a moment. But one of those is a mean reversion with the VWAP as a target, intraday trade. And one of those is a breakout momentum type trade with a kind of close at highs as a target. So two different things. And what I do is I have that target, and very often you probably got a trade idea with a target. I think it's going to fill the gap. I think it's going to take out that low. I think it's going to extend the fib extension, whatever you've got. Okay. But getting a trigger to get in sometimes is tricky. I'm waiting for a pullback and wait for this and that. This can act as a nice trigger. So when price moves in the direction of the target and you get an ATR spike indicating there's a lot of volume coming in. Now, that's not true. It's not volume, is it? But there is also a correlation between the range and the volume. But a lot of kind of money flowing in, a lot of movement in the asset in a very short period of time. And then that holds. Very often that's going to carry on and hit your not necessarily your target, but it's going to keep the momentum going. And moves that happen without that ATR spike, without the volatility spike, depending on how you want to frame it, often fail. And I bet if you go back and look at all your charts and you look at your breakouts, you look at all the stuff you've taken, if you take stuff that doesn't have that ignition bar, doesn't have that ATR, or at least a little bit after, sometimes you get a little bit of a delay and then it kicks in. but there's often got to be that as a prerequisite for it to continue. Now, could it reverse and take you out? Of course it could. That's why we've got stops, right? And I recommend putting the stop. Well, I don't recommend anything, but I like to put the stop under or above the ignition bar and thinking, okay, this might be an extra filter that I need to get involved with a trade. So let's look at a quick example. It's better with a example. Hopefully you can see that one. Yes. So 6 o'clock shot. I've talked about this one before, but I want to share it with you guys because it's a decent trade, right? It's a decent trading strategy. Who knows? It might stop. As soon as I've mentioned it, it's going to stop working, and you've got to manage the risk and all that type of stuff. But this is the type of concept. Rotational market, I've got to target the VWAP. I know that very often if the market's been rotating around the VWAP, it's going to touch the VWAP before the close, to put it in simplistic terms. I've got an ATR down here. When price starts to spike and ATR spikes, which in this case is a 1 period, spiking over the average, I'm getting involved in it. And my target is sitting at the VWAP. I am waiting to see volatility expand. Now, I'm using a very, very short-term ATR here, a 1 period, because by the time the ATR was kind of picked up a little bit, the move's already done. So it depends on what you're trying to do, right? You've got to kind of adjust and adapt. Same here, afternoon breakout trade. The afternoon breakout trade sets up. In fact, let me go back and explain the 6 o'clock a little bit more. It has to happen after 6 o'clock UK time. You have to be a distance away from the VWAP. In fact, I like this one so much, I've kind of got a program to help me work this all out. And maybe talk about this in a future webinar in a bit more detail. But it's got to be after 6 o'clock. That's why it's called a 6 o'clock shock reversal back to the VWAP, a mean reversion intraday play. Afternoon breakout for a different momentum type day, trending environment. VWAP is nowhere to be seen, and it's just pushing, pushing, pushing. A breakout after around 5 o'clock, generally, or my thesis is it's going to continue. And so I need to see that ATR spike. I need to see the range spike and a very short-term ATR for these specific strategies. Different if you're trading slightly longer term. And then I'd say, right, okay, that's interesting. ATR has spiked. We've flushed through the high. I think we could be okay. Now, this one tested your patience a little bit and was sitting and finally got going. But another little subtle indicator, guys, is if you have the ATR spiking in the direction of your trade continually, that is a good sign you're in a right trade. If you're in a trade, you're in a trend, it's like you often think, oh, should I keep it? Should I get rid of it? Should I do this? Should I do that? And you kind of second guessing yourself. And often, as traders, we close trades too early. You're trying to hold trades to final targets. When you see little ATR spikes or ATR picking up and trending up in the direction of your move, that's often a good sign that it's working. It's often a good sign that you should stick with it. And when you see kind of big moves against it, or an ATR spiking the other way as price moves the other way, it can be a little bit of warning signs. There's something to consider there. Okay, how long we got? We're doing all right. Risk management with ATR. So there's a couple of ideas and setups and stuff that you can explore. And really why I covered those is not to say, oh, go and copy these exact rules. Maybe we'll cover the exact rules and rule-based attributes of those trades in future. The idea is really just to illustrate the concept that whatever strategy you're deploying, very often ATR can play a good part, or volatility, depending on how you wrap it and say, hey, actually, when I see it spike, that gives me the green light. That's interesting. And using it from a sort of reverse engineering back from where your trade target is. Okay, so risk management with ATR. It's a natural noise filter. It's a great noise filter. This is the unsexy way of using ATR, right? People like the strategies and stuff like that. But if you can halve the amount of losers and halve the amount of rubbish you're getting involved in, your bottom line is going to be way better anyway. You know this. You know it. You know from last year's trade, you look at your trade, you go, man, why was I getting involved in some of that stuff? If I just chop that nonsense in half, the worst 10% of my trades in half, my P&L would automatically be better. And very often that's because we're getting involved in choppy environments without the volatility, without that supply-demand imbalance. Because if you think about why price moves because there's demand. There is time sensitivity. I'm coming in, I want to buy, and it's buy now, and it's buy now, and it's buy now. I don't care what price it is, buy, causing price to go higher. Versus price sensitivity is like, I want to buy, but I'm not paying more than 50. You can sit me on the bid at 50. I don't care. I don't pay more than that. And there's a difference, right? And when we get the supply-demand imbalance is when we have a lot of time-sensitive participants. I need in now, need out now, causing the market to drive in one direction. Sometimes it comes back and it's back and forth, and it's auction process of testing, backfilling. But that's where the opportunity comes, right? As a trader, you are trying to capitalize on that supply-demand imbalance. And so it makes sense that when the swings are larger and wider, the spring is more stretched. Oh, the supply is coming in, man, the supply. Oh, the spring is well stretched. There's your exhaustion, massive ATR, then ping back. It helps you calibrate to really getting in tune with the market and understanding, hey, it's supply demand imbalance where my edge is, not when the sort of seesaw supply demand imbalance is sitting there. Oh, there's a green candle, there's a red candle. No one can get on the end of that. There's very limited edge in that, I believe. And so, that's when ATR comes in. All right. Using a fixed or trailing stop based on ATR, very, very, very good way of deploying risk management without having to think about where you're going to put your stop. If you think about a trade, there are so many attributes to the trade: the entry, the target, the stop. Am I adding to the trade? Am I scaling out of the trade? How do I There's so many variables. And often as traders, we're trying to get better at a strategy. We're trying to discover a strategy, develop some edge. And, we try to adjust all these things. Like, do I do this? Do I do that? One way of doing it is to strip out the decision making. And I'm a big fan of stripping out decision making. When I'm deploying a new strategy, when I'm playing around with a new strategy, and I developed that 6 o'clock shock, what is it, a couple of months ago now. It's nothing new. It's pretty simple strategy. But I like to go, right, let me strip out the noise of the stop. Let me just run it with no stop for a bit. Oh, gosh, shock, horror, no stop. Obviously, small size, so that I'm not going to get absolutely hammered if the market suddenly has a flash crash. Chances of that I know are slim. But I kind of then want to go, right, okay, now then, how can I add a very simple stop process? And I'm not suggesting you trade without stops, but what you want to try and do, I believe, is to no longer have the decision of where do I put the stop. Oh, it's under that level. There's my key level, but if I put it under there, I might get pinged out. So do I put it wider? Do I, just really eliminate that? Remove that burden from your decision making. And as you develop a strategy, you go, you know what? I know the likely range is X because the ATR tells me the 10 period. And if I'm using a 1 minute chart, the last 10 minutes, it's been about 15 pips. You know what? I'll use that. Some days, maybe it's volatile. It's been 20 pips. You go, well, I'll use that. It calibrates to conditions and eliminates the need to overthink your stops. So you just use an ATR, a percentage of ATR, maybe use 50% of the ATR, maybe use 100% of the ATR, maybe use 200%, depending on what your objective is. Are you looking for a quick momentum pulse? In which case you might use 50% of the ATR. You know what? ATR in the 10 period has been 15 pips. I use 8. Okay, ATR has been 15, but I really want to be able to sit through some pullbacks on this. I'm going to use a little bit wider. I like this stop. So consider your objective, but I'm a really big fan of stripping out the decision making. Now you might be like, Mark, well, I want to be a bit more careful about where I put my stops. I get it. And there's no reason you can't add that layer on next. But I think if you're struggling to make a strategy work and to become effective, then one way of becoming effective is to say, hey, you know what? Let me just see what my entries are like. How good are my entries? And leave it for a period of time. I'm going off piece here, and I'm going to cover this in another webinar, but let me say this now because maybe it'll help you right this second. If you can strip out all the decisions and go, I am just going to go long or not. Example, I'm not going to consider short. I'm trying to find a good place to go long. I'm going to hold that trade for, let's say, 30 minutes. Could be 5, could be 5 hours. You decide. And I'm going to have a fixed stop of 100% of the 10 period ATR. Now you've stripped out any of the impact that a target has and a lot of the impact that a stop has. Because if you use a reasonably wide stop, you're like, hey, you know what? The ATR should keep me in. Now what you got to do is get good at buying. Just get good at finding that turning point. Now you start to go, right, well, is it a double bottom? Is it this type of candle? Yes, I take no. And you start to then just focus your mind on getting very, very good at your long entry at lows. And then you go, right, what about my long entry at breakouts? What do I need to see a breakout and pullback? A great method that Peter likes to use is in a Trader and Traders Mastermind. this is thinking, hey, how can I get very, very good at this? And then you go, right, well, how can I get very good at deciphering where my target's going to be? How do I get good at placing my stop? And really stripping out all the things you need to do to identify one thing is so, so key. I've just got off a podcast recording actually with a trader. That's going to come out soon. I have a podcast, Traders Mastermind. You can check out the podcast if you don't know already. Um, and this is a very, very experienced trader. I don't want to give away too much. It's going to come out. Hopefully, we'll make the edits required and have it out. But one thing, he said, and all the traders say this, guys, and I say this from my experiences, you've got to just be so focused on doing the one thing well, and sometimes it feels uncomfortable. Like, yeah, but I don't want to just be long. You don't have to stay there. But the beauty of the market is you can be very good at one thing and scale that up. You can go narrow and deep. You don't need to be wide. So that's just one of the advantages I think that you could use ATR. Automatically calibrates to conditions. It's fixed if you like, but it calibrates to conditions. But consider your objective with that. And if you were kind of looking for a larger target, you might say, hey, I'll give that more room. So ATR, super way to strip out the decision making of stops. If you're constantly getting stopped out, you feel like you getting stop hunted, then just consider, go back and look at your old trades and go, if I use 100% ATR on the 1 minute chart, 5 minute chart, of 10 period, 50 minutes, which would be 10 periods, what would that have done? Would I have stayed in the right trades? And then what you do is, I'm not going to linger on this too much, but then what you do is you go, right, that's what my trades would have looked like. How can I get better? How can I tighten those stops? Do I really need to let it go? Or actually, no, 90% of my trades that went against me by half an ATR pretty much went against me 100% of the ATR and stopped me out. So I don't need to use 100% of the ATR. I can use 50% of the ATR, but you don't know that until you try it out. So it's something that's, I think, is very valuable. Okay, I'm going off on a tangent. I do that sometimes. If you're new here, I do that sometimes, purely because I've been trading 20 odd years now. I lose track after 20 years. And I love the game. I love the markets. I love the constant challenge. It's just such a beautiful thing to be thinking about, a beautiful thing to be doing each day. And you're just trying different things, trying different strategies, finding different strategies, deploying those, seeing those work well, pulling them then out the market, adjusting them, tweaking them, another strategy. It's fantastic if you can make it work. It really is. Okay. And it's an example of the stop loss. It's an intraday high breakout buy, classical thing. And I'm not suggesting you do this. It's just an example. ATR-based stop, you'd use the ATR, a 10 period ATR on this 1 minute chart is running at 10. You see, I just load it on the bottom of the chart here. Run across, it's running at 9.5. So I'd have a trailing stop. If I'm going to use, I could use a trading stop. That's one way of doing it. You could use a trading 15-point stop. Did I mention the trailing before? I'm not sure if I did. I was so focused on, being able to strip out the stop loss burden from your decision making. But if you did use a trading stop and you were just saying, I just want to get that break, I don't want to sit in for a bigger pullback, I'm not interested, I want that initial key momentum going back to this point here, looking for a quick pulse, that first momentum. Okay, if that's your objective, fine, right or wrong, that's okay. But then you would say, right, well, I'm going to keep things tight. 15-point trading, stop loss, and you'd follow it up, and eventually you're going to get taken out by this little pullback here because that's more than 15 points. So one way of doing it, you make a decision, you make your objective, use ATR as a filter to keep you aligned with the conditions. Okay, some advanced ways. Advanced, is that the right word? Yeah, I don't think everyone's doing it, so maybe we can call it advanced. Let's call it advanced. We're all friends here. Let's call it advanced ATR applications. A good personal volatility alert system, and I'll show you how I'd set it up to alert me to the intervention or potential intervention from the Bank of Japan, but you can use it for anything else. Uses a trade exit signal, dynamic support and resistance levels. So what you can do with that is you can say to yourself, "It's a really good way of getting on a trend, actually, really good way." One ATR, let's say 15 points. If you go back to this, I want to get in only if we pull back by what I think is 1.5 ATRs, wasn't it? 150%. I only want to get in long if I see that pullback because I believe that that's noise. And I believe that the market as a rhythm and is moving in the direction, it's going to pull back in the noise amount. That makes sense. I won't explain it very well. Hopefully you get it. So, you kind of got the uptrend, it chunks back the noise. if it pulls back what I perceive to be noise or the edge of noise, I want to get long. So again, it's a way of aligning yourself and calibrating yourself to conditions and saying, I will buy this, but only if we pull back by 100% of the ATR, because I believe that's noise. I believe that's not a reversal. I believe that's just the natural ebb and flow of the market. And so then you go to take it even further. Got time? Yes, we have. Take it even further. You go, right, one ATR, 10 points, 15 points, whatever it may be. There's my buy. Maybe you're trailing it up. Then your stop automatically goes below that. So you're looking for a 2 ATR pullback, which has never happened in the, well, unlikely to have happened in a strong trend. Never say never, but it's unlikely to have happened. So you know that if it does happen, that's probably a reversal and you want to be out. So there's so many different ways of thinking about range cleverly and strategically that no one else is doing. I'm saying no one else is doing, but rather than just the traditional stuff of, oh, I want to do this and do that, be smart about how you deploy it, because there are ways that you can really, why it's one of my favorite indicators is because it's deployed from range, and range is such a really key metric. Okay, so talking about your trading filter, use the ATR to align with the best conditions. Example, if you're a Dow day trader, do you want to trade when the 10 period ATR is above 10 points? Yes, you do. Do you want to trade when it's below 10 points? You probably don't. And so if you're coming into the trading day each day and you're saying to yourself, hey, I want to take advantage of the Dow. I want to trade the Dow. Fine. Got a few Dow traders here. It could be any instrument, USD, JPY, cable, soybeans, whatever your preference is. Doesn't matter. But you want to have a filter that says, hey, this is a green light. This is a red light. When it's red, I ain't trading this because I get caught up and I do substandard trades. And again, if you don't believe me, you can probably go back onto your results and look, hey, when the environment was choppy, how was my trading? Pretty rubbish, I would guess. I don't know for sure, but I would guess. And I would, be pretty confident in that guess. So how can you set that up? Let's have a look. Load up your chart and time frame. I've got an example in a second, I think. Load up your ATR, add as horizontal line on level, hit set alert on crossing a line. Just like this. Here's the Dow 1 minute chart. And I'm using a simple example on 1 minute chart. Any chart you can use this for. And it's very easy to do on TradingView, and I guess it is on everything else. You set an alert. You set a line on your ATR at 10, 9.9 in this case. You just then set an alert on that line that says, hey, we've spiked above 10 ATR, which is the last 10 minutes. The average range of that has been more than 10. I want to get involved. And so when price starts to dip below, you don't trade. When it's above, you trade. And you can do this whatever you like. You can do this however you like. And one way I did this on the USD JPY, I'm not a big Forex trader, but I wanted to be, in fact, one of the only trades I took last year on currencies was after we had a little massive spike lower. And it wasn't actually an intervention. It was exhaustion after that big move. That's by the by. You can set this and say, right, if the ATR spikes to this, I want to be alerted. Now, that was a slightly different way of doing it, but this is like, hey, I want to use it as a filter. I'm smart. I know I don't have edge in choppy environments. What do I consider a choppy environment when the range is below this? Okay, let me put my filter in place. And then you can eyeball it. You come into the screen, you go, maybe you come into the screen at this time here. What would this be? 5 o'clock, not even 4:30, say. And you're sitting there and it's just trading at sort of, just below. You're like, you know what? I'm just, I'm not that interested in it. I'm just not that interested. Then when it starts to spike, you go, okay, because you can't predict this is going to happen, right? You can't be predicting this unless it was a scheduled event, of course. But then when it starts to kind of lift up and spike, you go, all right, maybe there is some opportunity. Maybe I can wait for that kind of wick through, test through lows that fails and bounce, whatever it might be. It's a good way of staying out shop. Okay. The other thing to, it's a useful tool, I believe, is to exit into ATR spikes. High ATR is generally not sustainable. Use the spikes to consider getting out of the trade and leverage on that time sensitivity to close your book. I talked about this. When people are really time sensitive, I want out now, want out now, want out now, want out now, whether there's shorts covering or buyers trying to get in. Leverage on the fact that ATR is spiking. If you look at your chart and you go back, you'll probably see a lot of times when prices reverse, when ATR is really spiked high. And so if you have got again, in context, relative to how other ATR readings have been, but if you see that that ATR spike and prices spiking, think about it. Go, do you know what? Maybe I need to consider exiting that because that was an emotional move. That's more emotion in that move than there has been in the previous moves, and we're at extremes. Is it sustainable? Hmm. Generally speaking, no. We've got to make generalizations in trading, of course, but that is definitely something to consider. All right. Ready for some Q&A. Let's just run over what we talked about. What is ATR? How it's calculated? Formula, volatility, used for trade setups at 6 o'clock shock, the afternoon breakout, risk management techniques, fixed stops, trading stops. Touch on the trading stops very briefly. Another application is trade filter or an exit criteria. Okay, so Q&A. If you have any questions, ladies and gents, stick them in. If you want to see more from me, if you're new, let me scroll right the way back. You can find me at tradersmastermind.com, and there's a lot of members in here already. Appreciate you joining, guys. The easiest way of kind of, if you like the kind of stuff I share, is subscribing to Traders Mastermind Daily. Free email sends out. It's now at 7,000 traders, and it hasn't been going long. You seem to like it, which is good, and I really enjoy writing them. Mixture of strategy, mindset, some funny stuff. Well, I think I'm funny now and then. But yeah, you can sign up for that. Let's go back to the end slide. I don't know why we need to, but I'll have it there just because it makes sense. All right. A couple of questions. Do you know what? Yes, possibly not a great idea having a Branson quote when he's been confirmed as one to visit Epstein Island. Well, you know what? I don't read the news. Um, whatever. A quote's a quote, and maybe if it turns out he has been doing stuff he shouldn't have been doing, absolutely right. But you know what? It's one of those things. Is a pullback more likely in a volatile condition? Yes, Sindri, it is because you think about what's happening. Spring is stretched, and the chance of that staying stretched and pushing and pushing and pushing and pushing and pushing and pushing, you know, isn't likely. It's not normal. It does happen, of course it does. Very often it's going to contract back the spring and then go again. So when you have these big volatile conditions, you exhaustion. If you think about underlying order book, right? I know that many of you are trading on CFD or spread bet product, and that's fine. You don't need to look at the order, but thinking about what's happening, when people are buying aggressively, they're sweeping levels, level, and then that's kind of causing the price to spike, and the liquidity, kind of a little bit of a liquidity vacuum, often causes price to pull back. So, got a short answer to that. Yes, is a pullback more likely in volatile conditions? I believe they are. And actually, when the price is just chugging, it's just sitting there, chug. Pullbacks are they're so unlikely. They're so that's not true. Reverse that. Of course, they're likely. They're less likely to be as volatile. They're less likely to be as aggressive because it's just sort of accepted price, and everyone's accepted it because it's taken its time. The volatility is much lower, so it's just accepted every accepted level. And you think about it, it's like, okay, yeah, that's the price. That's the price. Yeah, it's changed a little bit. That's the price. It's sort of the boiling frog, if you like, that people are just accepting of the new price. If price suddenly changes massively, like, whoa, hang on a second, I need to get out of it. It changes the dynamic and I think how the participants feel. Okay, thank you, Sindri. Chris D, how you doing, Chris? Man, you've mentioned a 10 period over 14 period when day trading a few times. Can you explain why you prefer and use a 10 period in all time frames? 10 period is the holy grail. No, it's just a personal preference. I just feel that the 10 period gives me a better insight into current conditions. I do use it on all time frames. Does it make a massive amount of difference? I don't know, man. I don't think it does that much. Maybe I'm just conditioned to it and I go, oh, I've got to use a 10. And if you like a 10 period, if it's 10 days, it's 2 trading weeks, right? You look back at 2 trading weeks, that kind of makes sense to me. And if I'm sort of looking at 5-minute charts, 50 minutes or so, maybe I should use 12 to make it an hour. I just feel like it's a good approximation. When I start to go more, it feels like I'm taking data from stuff I don't actually care about too much. It's like I don't really care what the price was doing 14 days ago, and it's having an impact on this calculation. Is there that much logic to it? Maybe, maybe not. But that's the way I look at it anyway. All right, cheers, Chris. Victor has said, can you shed a bit more light on thinking behind the ultra short 1 period ATR? You did hear it correctly, Victor. It's basically an approximation for the range of that candle, right? And so, it's telling me, hey, what's the range of this candle, and how is it comparing to the range of the average 10 candles, the 10 period ATR. And so when I see that significantly different, trading is all about context, calibrating to the current conditions and context, and then saying, you know what? Is something significantly changed? And that's what that is about. It's about, hey, this is something significantly changed to the average. And I know it's short term, but we're day trading that example. And, if your ATR has been sitting, 10 period ATR has been sitting at 15, all of a sudden you get a 30-point candle, you've got to pay attention. Now, whether you take a trade from that or not is a different matter, right? But I don't want to pay attention. I want to look. And for me, I kind of then reversed engineered it and said, okay, well, could that play a part in me having a price target and using the ATR as a way to trigger the entry? And I kind of looked at it and thought, yeah, you know what, that makes a lot of sense. And same even if you're kind of looking for a target of new highs or whatever, I think it's just that change in volatility, the instant change in volatility. And if we dig into that and hold that for a moment, dig into what that candle's saying, it's saying that for whatever reason, one participant or more likely multiple participants have decided to pay up much more and much more quickly than they have done previously. And you've got to ask yourself why. Are they always right? No, but there's a reason behind it. And is that the first sort of jump that everyone's now going to follow? Or is that just a spike that is not going to follow through? And there's a strategy around that as well, actually. But again, context is so important. But understanding that something's happened here, we've moved more than we normally do. So someone, and it could just be nothing, right? But when you wrap it all in with an idea of where the target's going to be, you wrap it all in with what you believe is an effective strategy, it can be like that's the first person's jumping. The first person's going, I don't know when. I do believe we're going to come back and hit that VWAP, or I do believe we're going to hit new highs or whatever it may be, but I don't know when. How do I time it? Well, actually, when I see somebody doing that, and the response is key as well. Maybe we haven't got time to go into that too much, but response after that is key. But it's really, that volatility change, the volatility shift, is super important. Okay, I think I've covered everything, guys. Thank you so much for your attention. I hope that's helped, and wish we're back again. We've got a couple of weeks' time, another one where we'll do a deep dive into something that hopefully gives you some value and some stuff to take away. All right. Thank you, ladies and gents, for your attention. I'll see you again. Bye-bye.